Good afternoon. Welcome this afternoon to Market and Sector Analysis, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined out there in the chat by my good friend Cameron May. Once again today, second time we've been together in this trading day. We just heard the closing bell. That means the cash market is closed, but we got a lot to talk about here as we wrap up the end of the day and kind of look forward. Welcome to all of you that are joining us, whether you're in the live version or whether you're here in the recorded version. We're glad to have you with us, no matter what. And of course, I'm filling in today for Michael Fairborn, who normally teaches this particular webcast. Now, given that, I wanted to just give you a quick programming note and update here. Given the similarities between this particular webcast, Market and Sector Analysis, that we teach on Wednesdays, and the webcast that I teach on Friday afternoons, Market Movers, we are now combining those two. We're moving this particular webcast, Market and Sector Analysis, to that 1 o'clock Mountain Time, or in other words, 3 p.m. Eastern Time slot on Friday afternoons. And that will start on October 6th. And in place of this particular webcast, I'm not exactly sure. Cameron might know what's going in this particular webcast slot on Wednesdays. I just know this. I know that I'm traveling a lot, and more often than not, Michael Fairborn ends up covering that Market Movers webcast for me. And so it just made sense to combine all of that information into one webcast. And Michael will do that. Typically, I will pick it up when he's not available, just like he picked up the Market Movers webcast for me when I was not available, which is more often than not on Fridays, given the fairly aggressive live event schedule that we have, which is great too. Love meeting all of you. We just got done with a live event in Dallas last weekend. And in a week, we're going to be back in Chicago doing a market drive event there as well. And then following that, a week or so later, we're going to be in Orlando doing a 2-day technical analysis and option strategies workshop. So we've got a lot of great webcasts. We got a lot of great workshops coming up, a lot of great education here for all of you. And we appreciate you being here because we like you. And we like you being our clients. Now, a couple of quick housekeeping items as we get into this discussion today. Remember that everything we talk about simply for illustrative and educational purposes only. It is not any kind of a recommendation or advice or recommendation. Remember that Schwab doesn't recommend to use technical analysis as the sole means of investment research. We're going to be using the Thinkorswim desktop software platform here today, specifically the paper money version. Remember that the paper money version of the platform does not do certain things. First of all, it doesn't predict the future. Neither of those platforms will. Successful trading in the paper money platform doesn't mean that you're going to be successful in a live environment. It also doesn't facilitate the early assignment of short options. It doesn't allow for studies to be used in scans. So there are some things, some differences. So just make sure that you're aware of those as you move your practice from paper trading to live trading. Also, remember, if we talk about options in this discussion, remember that options aren't suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Also, we may mention the futures contracts in this discussion as market evaluation tools, not as tradable instruments. But remember that futures and futures options trading involves substantial risk. It is not suitable for all investors. And in fact, it requires separate trading authorization. Make sure that you are aware of those risks and considerations before considering any futures or futures option transaction. Also, remember that past performance no guarantee of future results, and historical data should not be used alone when making investment decisions. Now, if we talk about anything in this discussion today that comes from a third-party provider, remember that third-party information is the property of and the opinion of third-party providers, not necessarily the opinion of or endorsed by Charles Schwab and Co. So as we have that in our backdrop here, let's jump into the Thinkorswim desktop software platform here this afternoon. And again, thanks to Cameron. Okay, it is going to be Scott Thompson talking about stock investing for beginners in this particular time slot. So that is great. And that's a great opportunity for many of you to learn from a great instructor, Scott Thompson, and kind of take it from that perspective of a basic approach. All right, let's jump into this understanding of what's going on in the market. Let's take a look at the market, then we'll break it down by individual sector and industry group strength, and we'll look at some individual components of the market that might be creating some movement today. So as we jump into this process, I'm going to start, first of all, with the S&P 500. And we're going to take a look at the S&P 500 in this particular case, kind of as the broad cross-section. And one of the things that I happen to notice, and I talked a little bit about this morning when I was teaching the index options webcast, is the idea that maybe we're getting a little bit of a signal for a bit of a short-term pullback. We saw a little bit of a pullback in today's trading. We saw a little bit of a pullback in yesterday's trading, maybe down into a potential support level. So we've got a pretty well-established level of support right here on the SPX, down around that 65.98 to 6,600 level, kind of right about there. And that level of support is being approached pretty quickly from this downward movement, although we did see a little bit of buying stepping in here towards the end of the trading day. As a matter of fact, if we pop down into a 5-day, 5-minute chart, you can start to see that towards the end of the trading day, especially after that lunchtime period, you saw some pretty good upward momentum. There was some sell-off kind of into that midday time frame, and then a little bit of a rebalancing and a little bit of pushback to the upside. In fact, that little bit of a pushback into the close took this above what would then at that point be the 55-minute period moving average. And so it took it back up above that moving average, which is acting as a little bit of a resistance level here in this 5-day, 5-minute chart. Starting to see that moving, the RSI, and again, RSI on the shorter term time frame is going to have some technical challenges. It's going to lag, but it is certainly one of those indicators that can be helpful even on a short-term time frame. By the way, if you want to learn more about the RSI or really any of the other technical indicators that you will see me or many of the other coaches use, Cameron May has a great webcast series on Fridays called Advanced Charting Techniques. And he talks about and breaks down a lot of these different technical indicators as a way to kind of evaluate the market. Now, he does it in kind of an interesting way, not really from the perspective of saying, hey, this is the best indicator to use, but simply presenting the indicator as, here's how this indicator works. Just go and test it and see if that works for you. And you make the decision as to whether or not that's an indicator that is helpful for you. So it's kind of an agnostic approach, which I kind of like in this sense, because it helps you to understand the mechanics of the indicator. So I'll have Cameron put the playlist link out there in the chat for those of you that are maybe not familiar with that discussion. So at that point, as we jump into this next step in this evaluation, let's kind of zoom back out, and we'll take this back to a 1-year daily chart, and we'll pop over here to the NASDAQ. Now, two circumstances here in the NASDAQ are kind of playing themselves out. And I talked a little bit about them again this morning in the Trading Index Options webcast. And much like what we just saw in the SPX, we're seeing this kind of pair of candles previously. So yesterday's candle and the day before's candle. So Monday's and Tuesday's candle. since today is Wednesday, and this is the Wednesday candle, and you see it in the SPX, same kind of thing. Those two candles together are oftentimes referred to as a tweezer top formation. Tweezer top formation. So I'm going to kind of zoom this back up, and we'll kind of maybe kind of reshift this view a little bit as we zoom back out, and we'll see if we can kind of see these candles in a little bit different perspective as I kind of shift this perspective. So now you see those candles as a little bit larger, and the intent is this. And oftentimes a tweezer top candlestick pattern will look like this, and you'll see a candle body and a candle body, and then you'll see an upper wick or shadow that is fairly large, right? But each one of those candles looks a little bit like this. So traditional tweezer top type of candlestick pattern looks a little bit like this. And oftentimes those candlesticks are two different colors. They don't have to be classically, but it's simply a representation of buying pressure pushing up and running into some price discovery, meaning finding an area where sellers are starting to sell. And that's kind of where that top area comes into play, where those tweezer tops kind of run into those areas. You start to run into that price discovery, and that's the point at which sellers are willing to sell, and they push that price down, and buyers are no longer at that point willing to push higher. That's why this can be in the short term an indication of a reversal, and we're seeing some follow through to that tweezer top type of pattern in here, both the NASDAQ and the S&P today. Today's candle is a follow through on that tweezer top pattern. Now, does that mean it's going to reverse? Absolutely not. There's no guarantee that, you know, in either one of those cases that we're going to see a complete reversal. We may see a pullback into a support level. So now what becomes critically important is what price does at that level of support when it approaches that level of support. But once again, in today's trading on the NASDAQ, much like on the S&P 500, we saw a little bit of buying pressure pushing back up from the bottom as we got into the close. Yeah, so Jay Richardson asked the question, so the green candle also has a sell tail on the tweezer top. Exactly. Price pushing higher and then getting sold into as it gets up to those levels. That's an indication, again, of that potential weakness on the part of buyers and that possibility of a little bit of a pull back into perhaps a support level. So we've got that support level in place. We saw it on the S&P 500, kind of that same perspective here, and kind of seeing that same element to this push. Now, does that mean that it's going to balance at that support level? No, that's not a guarantee. I mean, it could very well come down to, in this particular case, the 50-period moving average in both of these cases. We don't have a lot of economic data coming up in the next week or so, so there's not a lot of hard data that's going to push price. But think about this. We've got next week coming up. We're going to see jobs. I don't think that one's delayed. I think we're still going to get a jobs report on that first Friday, the 3rd of October. We're going to get a jobs report, a non-farm payroll report, which is really the only major hard data that we're going to get between now and then that could change this movement of the market. Now, let's take a look at the small caps. And the small caps had kind of a different candlestick perspective in the last couple of days. These are what we would refer to as a separating lines, in this case, separating lines bearish, because the red candle came after the green candle. So we had a hammer candle and then a shooting star candle. And that gives us that separating lines bearish type of perspective. And that's also a bearish reversal indication. Now, does it mean that we're going to reverse and move significantly lower? Not necessarily. In fact, today's trading brought this right down to this lower channel line, this lower trend line, and then there was a little bit of buying pressure stepping in. You see, however, a little bit stronger move to the downside in the RSI, given the fact that we have two subsequent candles closing near those lows. So there goes some of my, if you were with me in that index options class, one of our rolling orders just expired. We'll have to redo that rolling order. All right, so as we start to see this pushing back down to this downside, again, that it gives us an indication that maybe we see a little bit of a short-term pullback. But notice what these pullbacks have been doing over the last few weeks, in fact, over the last month, in fact, over the last 2 months in the Russell 2000 in the small caps. It's been push, 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 and then 1, 2, 3, 4 days sideways. Push, 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 1, 2, 3, 4, 5 days sideways. Push, sideways, push, sideways, push, sideways, push, sideways. So we're kind of in that mode at the moment in this particular case. By the way, speaking of in that mode, we've got a feedback survey out there in the chat. That feedback survey is how you can help us make these webcasts better. Now, remember, the range is 1 to 10. 10 if you loved it and you want to come back and you want more of this information. 1 if you just absolutely hated it and don't want anything more to do with this. So that's kind of the range. And then you've got an open question where you can fill in the things that you like about this webcast. And do us a favor, help us out with that, fill that out. You can even click on it now, set it aside, and then fill it out at your leisure. We kind of see that momentum kind of falling off a little bit here as this gets into that support level. So that's what the backstop, kind of the backdrop of this market looks like, is a little bit of a short-term pullback on the 3 broad market indexes. Now, I want to add into this mix. I want to pop over here to this mix into the VIX, the volatility index. Now, a couple of different perspectives on the VIX. I'm going to pop to the VIX by itself. And you notice something that has happened here, which is really unusual. We don't oftentimes see this. And I know we're down here in the bottom of the VIX. So what I'm going to, or on the bottom of this chart. So what I'm going to do is I'm going to grab this and I'm going to kind of stretch this out a little bit, see if we can zoom back down on that range. I may not be able to do that here, but I want to kind of stretch this out so that we can see these candles in kind of a little bit different perspective, so that we can see them maybe a little bit more as individual candles as opposed to just kind of that grind. Because there is a little bit more volatility going on here in the VIX than has been there previously. This moving average line that I've got on the VIX is the 30-period moving average of the VIX, which is in and of itself the VIX index, a 30-period average of SPX options, both in the money, at the money, and out of the money across a 30-day time frame. So notice what happened here. We had the SPX, which is what drives the VIX. We had the NDX, which is the NASDAQ, and we had the Russell 2000, all down on the day. And VIX was down on the day. Now, VIX was still up. If we think about it, from where yesterday's VIX started and moved to, it was still up. We still saw positive movement. But this was down on the day, so it was significantly higher at one point, and then we saw the VIX fall off. And that, my friends, is not something that often happens. Just like what's been happening over the past week or so, maybe 2 weeks, is something that doesn't oftentimes happen in the VIX in and of itself. So we've got some unusual things going on here in the VIX. So this is the VIX index compared to the SPX. And on here, I've put a correlation study. Okay. The correlation study is looking at the similarity of movement between the SPX and the VIX. So when there's a correlation above 0, that means that they are generally moving in the same direction. When that correlation is down here at -1, which is normally where the VIX stays, where that correlation stays, that means they move in opposition to one another, which is what we're normally used to seeing. Market moves down, VIX moves up. Market moves up, VIX moves down. That's that normal relationship. But look at what's happened now. This correlation has flipped, and it's gone up to that positive correlation. We've got a positive now. It's not a one-to-one correlation, but it's a positive correlation. As the VIX has gently been rising, so has the market gently been rising. That's not usual. That's not a usual scenario to have happen, especially over that period of time. You may see individual days when you have market up, VIX up, but very infrequently do you see a week period or 2 weeks of market up, VIX up over that same period of time. And that's why I say, look, for the first time in an entire year, this correlation study has flipped to a positive correlation between these two. That is really kind of an interesting scenario and what that suggests. And again, this is an inference at best. This is not a direct correlation, but the inference here from that correlational study flipping to positive is that there is more call buying activity going on than there is put buying activity going on, because call buying activity can increase option prices the same way that put buying activity increases those prices. The reason we don't normally see this is because it's not a usual scenario where there's more speculative call buying than there is protective put buying. That suggests more bullishness on the part of the market, more risk on approach. Now, we see this little bit of a pullback and we see VIX falling. So what that would suggest is if the market's pulling back a little bit, well, let me ask you. I'm going to ask you here in this particular case, right? When prices are high, when option prices are high, or really when prices of anything are high, what's the net effect of that? What happens when that situation happens? When prices of a product that are in demand are high, what happens? Two things generally happen. Well, one of those things that generally happens is you get more sellers coming in that are attracted by those high prices. So if you've got a fungible instrument where there can be more sellers, high prices, meaning high call prices, are being sold by more sellers. And when you have more sellers coming into those high prices, guess what they're doing? That's going to push that price to the downside. So that being the case, the fact that we had, and this goes back to the idea of why we're maybe seeing the situation that we saw today with the VIX down, but the market down, that may simply be a matter of those call sellers coming in and selling call spreads, picking off some of that high premium and bringing that premium down a little bit. So that being the case, it's kind of an unusual situation. What does that mean for us as individual traders? As we look at the market and as we look at the sector, it means that there's still some bullishness there, but in the short term, option sellers have been coming in and selling off some of that elevated premium. Now, that's in the market as a whole, not necessarily individual positions, although you have to make the assumption that if the market as a whole, i.e. the SPX, is seeing that elevated implied volatility, that it's individual stocks as well that are also seeing that elevated implied volatility, and that elevated implied volatility is getting picked off as it rises. Now, one other chart here really quickly, you can see that disparity between the VVIX, the volatility of the VIX index, and the VIX index itself has been growing, in fact, to almost the widest separation that we've seen in at least this back half of the year. This is the largest separation that we've seen generally between VVIX and VIX itself. Again, that's suggestive of a lot of activity going on, buying those VIX options and creating those price moves, and now selling off some of that high premium. So what that suggests is if we get a move to the upside, and there are lots of call sellers that have been selling calls, if we get a move to the upside and some of those call strikes start to get plowed over, what's going to have to happen? There's got to be buying of stocks or buying of options to satisfy those obligations. And we could get into an additional bullish push to the upside. I think overall, this is generally pretty bullish in this particular case. Now, that's simply what technical analysis would suggest. That's not my opinion. That's what technical analysis, that's what this probability and volatility analysis would generally suggest. All right, so now that we kind of have that as the backdrop, again, let's bring this into our sector level assessment. So I'm going to look at our S&P sector index grid, and let's take a look at what sectors are currently showing a little bit of strength. Now, one of the areas that was really kind of interesting to me over the course of the last little while was the consumer staples versus consumer discretionary. So these are all of the sectors of the S&P 500. Energy, materials, industrials, consumer staples, consumer discretionary, healthcare, financials, information technology, communication services, utilities, and real estate. So let's pop into one of these and let's kind of go through this individually and let's take a look at what's going on. So energy starting to pop a little bit higher. Crude oil up a little bit. If we were to put on here, I'm going to just go to my studies and I'm just going to, in the really quick comparison here, COMP comparison, I'm going to put on here the crude oil futures contract. Now, again, I'm not using this as a tradable instrument. I'm using this as a measure of market perspective. So we're going to put on here a comparison to crude oil. And you see that crude oil is starting to move a little bit higher. In fact, kind of breaking out of this little bit of a double bottom type of pattern here, and that's helping to lift energy. You can see that crude had kind of trended below energy. Energy seeing a little bit more upward movement. Now crude oil kind of following along. So you could ask the question, is this chicken and egg? Which is coming first? Is it crude moving higher that's driving energy, or is it energy sector stocks moving higher that's lifting crude a little bit behind it? And I would argue you were seeing some investment CapEx spending in energy with the assumption, and I think this is, again, a bullish indication potentially from a technical analysis and kind of market and sector analysis perspective. The fact that the energy sector is starting to pick up strength and seeing a little bit of a breakout here suggests an expectation on the part of the energy sector that there is a little bit more bullishness in the economy and a little bit more bullishness in the market. All right. Now, let's take a look at materials. And as we start to see this materials space, again, driven by energy, this is, again, a fairly consistent relationship, breaking below that moving average. As crude oil prices go up, those producers of materials may be seeing a little bit higher input costs and seeing that move back down to the other side. Now, the other side of this coin is some of these materials manufacturers or materials producers are seeing supply constraints in things like uranium and some potential challenges because of the demand for energy, which is what we're going to see in the utility sector here in just a minute, as well as in the industrial. So let's take a look at industrials here. Industrials continuing to pick up a little bit, although these are kind of mirroring small caps. And one of the reasons that they're mirroring small caps here is because many of the small industrial manufacturers that fall kind of within this space, then, and are big drivers of this space, the Mag 7 industrials and the Mag 7 Halo industrials, those are going to be those small caps. And we've seen small caps kind of backing off a little bit here in terms of those industrials. But overall, that CapEx spending, kind of the onshoring of manufacturing capacity and so forth, that's been holding these industrials up a little bit stronger. But they're still up above that 50-period moving average in this particular case. So there's still some strength here in industrials. All right, consumer discretionary. Now, this is one of those things. it probably isn't wise to bet against. I don't know. It just doesn't seem wise to bet against the U.S. consumer, at least the relatively affluent U.S. consumer, because there's still spending going on. And you can still see that in the consumer discretionaries as they continue to move higher, although we've seen a little bit of a pullback here. With a little bit of that easing of interest rates, that tends to lift consumer discretionary somewhat. But this is kind of that realization and digestion of, is good news good news? Is good news bad news? Is bad news bad news? Is bad news that created the circumstance for a rate cut bad enough that it kills the consumer discretionary space? All right. Consumer staples. Now, I talked a little bit about this in the market drive. I've talked a little bit about this. This is kind of that support level that consumer staples. If you think about consumer staples as defensive stocks, this is, again, another bullish indication. The fact that consumer staples had kind of been maintaining this base here, right around that 676 or 876 level or so, as a support level. That base was really kind of that defensive area. Every time consumer staples as defensive got down to that level, they got bought a little bit and pushed back up. Now we see this break below. And you think about what consumer staples are in relationship to things like consumer discretionary or other areas. This is the risk off perspective. And when it's below that level of support, that's definitely a potential risk on. When you see consumer staples moving higher, in fact, breaking above that 50-period moving average, that's risk off. So we've broken below, we've retested, and in fact now come down from that resistance area, what was previous support, now acting as new resistance, again suggesting risk on. And now then the next question is, where is the risk on? So healthcare kind of moving sideways. It's not really occurring in the healthcare space. We're just kind of seeing healthcare establishing a base. I think there's a lot of tumult here because of political overhang and geopolitical risk in that space. Financials kind of banging their heads and kind of getting squeezed, if you will, up against this resistance level. A little bit of relief off of that resistance and out of that squeeze caused by interest rates backing off. But that's a double-edged sword always for the financials, because companies that make money on other people's money benefit from higher interest rates. But the conundrum is that when interest rates are higher, they have less capability to loan because people are less willing to borrow at higher interest rates. So it's that double-edged sword. So this is the realization of that double-edged sword. What breaks this one direction or the other remains to be seen. Okay? Yeah, staples below the 50 simple moving average and below that level of support is risk on for the market, not for staples, because staples are defensive, but risk on for the market, because that suggests that the buying pressure is elsewhere, not in consumer discretionary or not in consumer staples, not in defensive nature stocks, right? Not in stocks that are considered to be defensive in nature. Financials, again, what's going to break it? I don't know. What's going to break this to the upside? But boom, here's where the risk on is coming into play, right? This is where that rotation is happening once again, out of this sideways consolidation into the risk on perspective, even though we've seen this little bit of a pullback into a support level, maybe looking for the possibility of a bounce, maybe a bull flag in infotech. And then we start to look at communication services again, very similarly to infotech. Communication services is kind of the technology halo, if you will. Some of the streamers are in this space. Some of the kind of mixed use technology companies in this space and communication services. So looking for a potential bounce off of that support level. And utilities, as interest rates have been backing off, look at what's going on with utilities. We know when utilities are sensitive to interest rates. We know that because they bond for capital improvements. We know that because they bond for infrastructure build out, lower interest rates benefit utilities. And now we're seeing it play itself out in this kind of skewed double bottom reversal to the upside. Does that mean it's abjectly bullish and that we've seen it breaking out? No, but this is a pretty strong reversal indication, a pretty strong reversal pattern, maybe back up into these areas here. The other thing with utilities, remember what I said, though, about the AI build out, and you start to think about what's going on there in terms of energy capacity. There's a huge backlog of infrastructure, especially in the energy space, the electrical energy space primarily, that has to be accounted for in utilities because they've got to build out that infrastructure. So if they have the ability to build that out because there's spending happening, think about the companies like Microsoft and others that are buying up utility companies, that are buying up capacity from utility companies. There's a potential risk on here in terms of that particular sector of the market. And real estate just kind of churning along, not really moving outside of the range here, really whipsawing up and down right around this 50-period moving average. And I think until we get a clearer direction, I think Friday's speech by Jay Powell kind of put a damper on things with that possibility of, well, is there a navigable path to more interest rate cuts? Again, is a challenge for the real estate space. So as we're starting to look at this, these are the things that are shaping this marketplace. So let's take a look at some of those leaders here before we run out of time. I want to pop back to my single grid. And I want to do this, actually, I'm going to do this in two steps. I'm going to look at, first of all, our stacks grid and the stacks versus the SPX. Now, stacks, as you know, is the Schwab Trader Activity Index. Stacks. It is a monthly accounting of the activity of Schwab clients. Now, not individually, but collectively. And you can see that going into that April timeframe, Schwab clients were getting bearish. They were selling stuff off. Now, since that timeframe, they've been buying and pushing things higher, which is consistent with, and in fact, kind of leading what's going on with the SPX. So Schwab clients getting a little bit more. And again, remember, this is not a tradable instrument, and this is not historically correlated at all. We're simply looking at this as a coincidental measurement. You can see that traders getting a little bit more bullish. Now I want to pop over here really quickly to our single grid, and let's take a look at some of the leaders. NVIDIA, part of the Mag 7. It's been one of the leaders. We're seeing that little bit of a pullback into a support level. Let's take a look at a couple of others. Apple, AAPL. And Apple breaking out, running back up to a bull flag resistance. In fact, I talked about this a couple of weeks ago in a webcast that I was teaching. Bull flag, rally up, pull back, bull flag, and it ran. It took a little bit longer, but it ran right up to that target. Now seems to be pulling back into that bull flag potential now. AMD in the chip space, starting to see that little bit of a reversal here, kind of building that base, breaking up above this support level. Now, in the kind of ancillary space to this, RGTI, I know this is a question that a lot of people have had in terms of this space, breaking out of this long-term base. But the thing that we maybe pay attention to from a technical analysis perspective is this right here, the base of that basing pattern. If we were to duplicate that and take that right here and put it up here, guess where this ran into a resistance level? Right about that measurement target of that pattern. So could we see a little bit of a pullback? Yes. Is it dependent on that as a resistance level? No, but that is potentially an indication of where that would run to. The market likes symmetry. Now, others in the space, Google kind of breaking out of this double top pattern and maybe making that move to the downside. But I think, again, once we were talking about NVIDIA and Apple and a few others kind of making that little bit of a pullback, that is, I think, consistent with that technology pullback just a little bit of looking for other leadership. Let's take a look at this one, TSLA, and Tesla starting to see. That kind of looks like that little upward flag on the VIX too, doesn't it? But again, that breakout. So what we might do is take this basing pattern that it built for a while, take that and duplicate it and put it up here on top and say, hey, you know what? Maybe this has some room to move to the upside before it runs into resistance. But if we go back over here to the left, it's always a good idea to look left to confirm what's going on right. We've got a little bit of a resistance level over here on the left-hand side. So as this continues to move, we see some upward movement in terms of volatility and momentum, but not yet seeing much of a pullback. So there are some opportunities there in terms of that space, that Meg 7 space. A couple of others that I want to look at, aside from, again, remember, I can't look at ETFs in this particular class, but let's take a look at what's going on here in the streamer space. A little bit of consolidation to this downside. This is one that I've been watching for a little while, just simply because it's starting to consolidate. And we're kind of getting that squeeze right around this range here in Netflix, kind of around the center point, around the 1226 mark. And if we were to look over the horizon, I'm going to add a little bit of time out to the front of this particular chart. We've got an earnings announcement coming up in this next cycle on the 21st of October. So that's not that far over the horizon, and that seems pretty consistent with the apex of this triangle. If we were to continue to move that to the outside, we might see this kind of continue to squeeze to that point. And so looking for this to move up or down based on that earnings announcement drive to the upside or to the downside. Don't know what the earnings announcement's going to do. So that's why we're seeing kind of this coincident squeeze of levels of support and resistance in this particular case. Now, one last one before we go. I know we're just about out of time, but this is GE Aerospace. And so you look at GE Aerospace kind of as a purveyor of upward trend. And this is the one thing. Yeah, we've got an earnings announcement over the horizon, but we started this discussion with candlestick patterns. I want to end this discussion with candlestick patterns. We have this big, giant, bearish engulfing pattern on GE, and we haven't seen one of those for a while. So what does that tell you? Given the fact that this trend has been moving higher, that if we're seeing similar types of patterns on a lot of these technology stocks, including GE Aerospace, which has been a reliable and consistent trend, that maybe there's some rotation out of some of these traditional names that have been leaders and into areas that have that potential for more upward movement. So the question is, where is that potential? Well, we saw it in industrials. We saw it with the potential in financials. We saw it also with the potential in technology and in consumer discretionary. So as we start to make those rotations, take a look at where that strength might be moving. It's not evident at the moment, but take a look at where that's going. Now, by the way, really quickly, fill out that feedback survey that's out there and look for, again, following us over here on the Trader Talks webcast page. Click on subscribe, and you've got all of those in-person events that are coming up. Here's the Market Drive in Chicago, and then following that, we're going to be in Orlando as well. So my thanks to Cameron May for helping out. My thanks to all of you for being here as well. Remember to fill out that feedback survey. And yeah, I did say energy is one of those areas as well. Guys, have a great day. We'll talk to you again soon. Remember, this is going to be moving on October 6th to Friday at 3 p.m. Eastern time. Take care, everybody. Bye-bye.